structure didn't break. It relocated. We begin on the 1-hour chart. Because this structure is not understood by isolating individual candles. It is understood by connecting sessions and observing how time is processed as price moves through them. The key reference begins with the Asia session of February 3rd. That session established a balance area, not as support, not as resistance, but as a structural midpoint. This midpoint was not a level to trade from. It was a reference for where future sessions would spend time relative to prior balance. What matters here is not the price itself, but how later sessions behave relative to that balance. When the U.S. session of February 4th began, its anchor candle formed below the midpoint of the February 3rd Asia session. That starting location already mattered. It reframed the structure immediately. From this point forward, the question was no longer whether price would move higher or lower. The relevant question became whether structure was being repaired back toward balance, or whether time was being accepted below it. As the U.S. session developed, its anchor candle expanded to more than twice the size of the prior Asia session anchor. This expansion was not directional information. It was information about capacity. The market was able to process more range in less time. Volatility was no longer contained. That tells us the session was capable of absorbing more structure than the session before it. At the same time, the 20-period moving average became clearly defined as resistance. Price did not reclaim it. Price did not rotate around it. Price did not compress back toward it. Instead, price separated from the 20-period moving average, increasing distance rather than reducing it. That distance matters structurally. It tells us price was not negotiating value. It was accepting time away from its short-term equilibrium. While this was happening, the 120-period moving average continued to slope downward. There was no flattening. There was no rounding. There was no loss of angle. The slope remained consistent. That tells us the longer-term structure was still intact, and that any short-term pauses were occurring within that broader framework, not against it. An important interaction developed during this phase. The 120 moving average moved inside the short-term Bollinger Bands. This is not a signal. It does not imply resolution. Structurally, it tells us that short-term volatility had contracted enough to pull long-term behavior into its range. Short-term and long-term structure began to overlap in time. This creates compression, not decision. This is often where expectations form. But structurally, nothing needs to be anticipated. The market was not deciding. It was compressing multiple time frames into the same space. The Asia session of February 4th then opened below the U.S. session anchor. Its anchor candle was larger than the prior Asia session, but it began from a weaker structural location. As the session progressed, price failed to hold the Asia session structure. Price traded below it. This behavior was not continuation. It was not confirmation. It was acceptance. The market accepted spending time below prior balance, rather than repairing it. Throughout this process, the 20-period moving average remained unreclaimed. Short-term Bollinger Bands stayed lower band dominant. Upper bands remained relatively closed. Here, opening and closing do not describe direction. They describe where volatility is allowed to expand and where it is constrained. RSI on the 1-hour chart adds information about speed, not outcome. RSI lifted from lower levels, but the slope of that lift was shallow. This was not acceleration. It was deceleration. The market was slowing down while remaining within structure, not reversing it. That distinction matters. When the structure is understood on the 1-hour chart, the 15-minute chart stops looking noisy. It stops being a place to search for precision and becomes a place to observe repetition. Moving to the 15-minute chart, we are not looking for new answers. We are looking for how the same structure is being processed in smaller units of time. What appears on the 1-hour chart as separation and slope appears here as repetition. On the 15-minute chart, the 20-period moving average continues to act as resistance. Price approaches it. Price tests it. But price does not spend sustained time above it. The 120-period moving average maintains a downward slope. The angle is gentler than on the higher time frame, but it is consistent. This tells us that lower time frames are not disagreeing with higher ones. They are expressing the same structure more slowly. No transition, no regime change, just continuation of the same process on a different clock. Bollinger Band behavior on the 15-minute chart becomes clearer in this context. The lower band opens first. The upper band remains comparatively closed. This asymmetry matters. It shows selective volatility acceptance. Expansion is allowed on one side, while the other side does not invite participation. This is not a breakout condition. It is not a resolution. It is controlled, selective expansion. RSI on the 15-minute chart forms higher lows. But again, the slope remains moderate. Momentum is not expanding. It is stabilizing. This mirrors the 1-hour behavior exactly. Not reversal, not continuation, but loss of speed. When structure is viewed across both timeframes together, the chart stops asking for answers. There is no urgency here. There is no moment that demands resolution. Across the 1-hour and the 15-minute charts, the same structural behavior continues to repeat. Short-term and long-term Bollinger Bands are interacting rather than separating. They are not expanding away from each other. They are occupying the same space and time. This tells us that volatility is being processed, not released. The 20-period moving average and the 120-period moving average both point in the same direction. They do not operate on the same clock. One responds quickly. The other responds slowly. But neither is contradicting the other. This alignment does not imply outcome. It implies consistency. Session anchor candles continue to form below prior structural balance. No session has reclaimed that balance. No session has repaired it. And no session has decisively rejected it either. Instead, each session accepts spending time in the same displaced area. That is not indecision. That is structural acceptance. RSI across both timeframes reflects the same condition. Momentum is not accelerating. It is moderating. The market is not building speed. It is losing it gradually, while remaining inside structure. This is not reversal behavior. It is not continuation behavior. It is time-based processing. The market is choosing duration over expansion. And as long as structure continues to be processed this way, nothing needs to resolve quickly. Nothing needs to be forced. The structure did not fail. It did not break. It relocated. And the market is still allowing time to do the work.